So now we have a very dangerous situation where the Fed says they won't be lowering rates, but the markets, they don't believe them. And so they're betting on just the opposite direction. Both are attempting to call each other's bluff. And the reason this game of chicken is so different is because it's actually the most dangerous for the public, not the people playing the game. There are two ways that this can go, and it ultimately leads to the same result. Well, how much time do we have? And do I protect my wealth differently depending on which of those happens? These are the questions we'll answer coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies that are, oh my goodness, what a concept, based on your goals and put your best interest first. And I'm telling you, we are running out of time to make those things happen. So where are we at in this next evolution of the loss of the market's confidence in the Fed? Because remember, there's only one level of confidence that's left, and that's the public confidence in the Fed in the currencies. So let's just go ahead and begin. Because we're seeing since the beginning of the year, markets have gone up dramatically. Well, guess what that's led by? Very much by stock buybacks from corporations. And what I really want you to understand, well, let's take a look at this. January authorizations, this is from 2005 to the present, and look at where we are, and we're just at the beginning of 2023. These announced buybacks more than tripled from a year ago. But what I really want you to understand about this is that once that money boosts the stock and they spend it, doesn't go back in the corporation if they need help. We'll talk a little bit more about that in just a second, because this is really where we are. Corporate America continues to splurge on its own shares, a force that has fueled the New Year rally. And by the way, these valuations are the highest ever, 27 times forward earnings. And can you please tell me what those forward earnings are going to be in this particular environment? So they are buying their shares when they are the most richly valued in history. That certainly makes sense to me. I hope you realize I'm being completely facetious. At a time when recession risks are mounting amid Federal Reserve tightening, the buying spree may be viewed as a ruthless deployment of cash. And like I said, once they spend that money, it's no longer in the corporations. So just like we saw with Boeing a few years ago, and Boeing is very big on share buybacks and dividends and all of that, taxpayers had to bail them out. Are we going to be forced to bail them out again? And will there be winners and losers in this? There will definitely be winners and losers, even amongst the corporations. Bank of America warns investors risk sleepwalking into a sell-off. This is going to be much bigger than a sell-off. This is a game of chicken. And my question really is, will the Federal Reserve, in their desire to prove that they still have control of these markets, will they force an even bigger recession than they would have had otherwise? Because what are we hearing about? We're hearing about this Goldilocks soft landing and a soft recession. This isn't going to be soft. There's no way. There's too many things that are going on, and they have to shift this. And the only tool that they have is money printing. They've raised the interest rates, and that's pushing us into a depression. And there's only one way to fight that, and that's with inflation. But just like this will be a hyperdeflation, I believe really strongly that this will be a hyperinflation. It's the only way to fight it. I mean, therefore, it makes it easy. But what you really need to understand is that there is a risk on, right? So corporations make their stocks look like they're going up, and then people have this fear of missing out, especially in the face of the inflation. Global equity funds had 44.7 billion of inflows in the past 4 weeks. This is risk on. Stocks have rallied since the start of 2023 on signs of cooling inflation. It's a little bit of headline inflation. It's not going to last. Optimism over China's reopening and hopes that slower economies will, this is the real reason, people, force global central banks to pause hiking rates, and dare I say it, they're even betting on them lowering them. The number of countries at risk from corporate distress spillovers has risen after a decline in 2021. Well, what is that? What is a spillover? That is a corporation collapsing and having an impact on the banks and on the government debt and on every aspect of the global economy. And consumers are cutting back on their consumption because of all of the rising inflation, which the Fed is trying to fight, presuming they're actually trying to fight it, with higher interest rates, which then makes it harder for these corporations to service or roll over their debts and to take on more debt. This is the area that, as you can see, is very rapidly growing. And like I said, and like I told you in August when this happened, markets no longer believe the Fed. They gave up that. Why they gave up that confidence at that point? Maybe because they felt, I don't honestly know. Markets no longer believe the Fed. Why they gave up their credibility to the markets in August, I can't really answer that. But now, when the Fed says something, markets go, So market pricing has shifted rapidly to price in rate cuts. And the Fed is saying, we are not going to cut, we're going to keep raising. And yes, they only raised 1/4 point, still well below inflation. That's not going to do anything. But the markets are going, yep, you're going to start cutting. And the central banks are going, no, we are not. We are going to continue to raise, and we're going to hold it there for a long time. And I'm recording this before Fed Chair Powell speaks today, so I don't know exactly what he's going to say. Sorry about that. But also what I want you to recognize is that this line here are all the times the Fed has raised the interest rates. And look at, the conditions, the financial conditions are as easy as they were before they even started. So all of this has been a waste. Why? Because we are at the end of this currency's life cycle, this big fiat money experiment. So what would have worked in the past no longer works. You see what I'm saying? When I've been saying the Fed is out of tools, the only one they still have is money printing. And when they turn around to do that, to fight this looming inflation, there's your hyperinflation. I mean, I really think it's already begun. I just don't think that that is recognized yet. But the central banker market dissonance is more than just a war of words. The bullish bets on a shift to rate cuts, in other words, the markets think that they're going to cut rates, may in fact mean policymakers, central banks, are forced to hold rates at higher levels for longer to achieve the tightening that investors are now actively undermining. So the markets are at war with the Fed. Remember that saying, don't fight the Fed? Guess what? The markets are fighting the Fed. This is a very, very dangerous game of chicken because these looser financial conditions, they are a problem for the central banks. Central banks aggressively hiked interest rates last year as inflation in many countries rose to the highest levels in decades. Now, falling energy prices are reducing headline inflation and fueling optimism that monetary policy may be eased later this year. In other words, that they will pivot and start to lower rates so that these corporations can continue on their debt-feeding frenzy. The reality is despite all of that sharp monetary policy tightening, financial conditions have eased around much of the globe, posing a challenge for the central bank. And what are the central banks doing because of this? Well, frankly, they are buying gold. Now we have the full year 2022. Keep in mind that global monetary system was changing in the 60s, and there was a run on the dollar by foreign governments sending in their dollars, pulling the gold out of the U.S. system, creating more restrictions around what the governments could do. And of course, in 1971, when we had less gold in deep storage than we did prior to the confiscation in 33, Nixon closed that gold window, which doesn't sound that bad. But what he actually did at that point was hand over full control of inflation to central banks. That's a problem. So what you see is that central banks have been preparing. I have too. Have you? Because this is real money. This is real money. It runs no counterparty risk. You want to see counterparty risk that looms ahead of us? Voila! Lebanon devalues their currency. Sorry about that. Devalues their currency by 90%. Now look at this graph. This is gold to the Lebanese pound. And you can see this little line. Oops, let me grab this laser pointer. Not doing it. But you can see that kind of stayed steady, and then all of a sudden, overnight revaluation. So do not trust what Wall Street is telling you gold is worth. Those are contracts. They are not this. And I've been showing you now the decoupling between the paper and the physical markets for a while. But ultimately, they all come back together, and that's what we see in the Lebanese pound. This isn't the end of it. This is the beginning of it. They lopped off zeros. So it actually went up over 12, almost 1,300% overnight. Let's see. What do you want to be holding when that happens here? You want this or you want this? This is what I want. And I hope you have some too. Because ultimately, all those numbers actually converge. Beirut, January 31st. Lebanon will adopt a new official exchange rate of 15,000 pounds per US dollar on February 1st. Central bank governor, marking a 90% devaluation from its current official rate that has remained unchanged for 25 years. Banks have severely limited withdrawals of dollars in lira. You think? Since the start of Lebanon's economic crisis, 2019, that's not that long ago, the lira has lost around 97% of its purchasing power value. Get to good money, and get to food, water, energy, security, barterability, wealth preservation, community, and shelter. Get your preparations done. So it's critically important that you subscribe, because now there's so much information coming fast and furious. You need to stay tuned to know what the next most likely outcome is. And if you haven't already, make sure you watch last week's video on the hidden truths behind the US dollar and what's next in the economy. Also, stay tuned for this Thursday's video on markets fighting the Fed. And if you haven't done this, really, start your gold and silver strategy. Start your wealth shield, because shields are made of metal, not paper or promises. That's all counterparty risk. So if you haven't, make sure you subscribe, leave us a comment, give us a thumbs up, and share, share, share. And until next we meet, please be safe out there. Bye-bye.